G'day. Welcome back everyone to the S&P 500 and the NASDAQ chart review. Now both charts are still bullish and we'll include some back testing which demonstrates how you could have traded using one of two strategies. So don't forget to hit that like and subscribe button to support the channel. In terms of the outlook as of today, June 7, earnings growth cooling. S&P 500 second quarter profit growth is projected around 4.9%, the slowest since late 2023, while first quarter showed solid 13% gains. Tariff and macro risks, ongoing US-China tariff policy and sticky inflation point to corporate margin pressure. Valuation and technicals, the S&P recently tested the key 6,000 level. The SPY was trading around 6,000, trading near 21 times the forward PE ratio, signalling high valuations and potential resistance. Optimistic strategists, projections from Morgan Stanley, Goldman Sachs, UBS are bullish with 2025 targets ranging from 6,200 to 6,500, citing strong earnings, AI and resilience to higher yields. NASDAQ momentum, the NASDAQ has rebounded sharply with May's plus 9.6% gain, but technical analysts warn of consolidation and sideways action through June. So looking at the S&P 500 first, we always look at the long-term trends. So first on the trends, we'll look at the CCI 150. That's broken below the moving averages, even though the price is above its respective moving averages. So that's a weakening signal according to the CCI. So we might see a drop off at some point. Notice also we had a bearish divergence which already retraced back down to our initial target. So if I was to draw a retrace for those new to the channel, we always take it back to the previous low before that divergence started. And the way we measure the divergence is from that high to that low to that high on the CCI. Declining highs versus higher highs on the price, the same period. We take back the Fibonacci from that range to that low before the Fibonacci started, and that's how we measure the 23-38% minimum range. Now in this case you can see the wick of that candle broke right into that, bounced up mid-range between that 23-38%, and it bounced out of there very quickly the next month. Now they don't always do that. Sometimes they break right through that 23-38% range, in which case we take it step by step. But at the moment, you'll notice the CCI is still dropping. The other thing I want you to notice as well is on the monthly, we've got these, if I zoom in a moment there, we've got these fair value gaps. Now these fair value gaps, generally what happens is, you can see back here, the preceding months after that candle there broke into that and filled those orders. And the way these fair value gaps works is we take that candle, for example, we take the high, the wick of that one, and to the candle afterwards. So you've got to wait for the candle after to complete. So we take the high of that candle to the low of that candle, and that's identified by that, called the fair value gap. The same thing happened on that candle. And what we expect to see is, at some point in the future, we expect the price to retrace at some point down there. You'll notice back here we had a fair value gap, and it retraced almost immediately down to there. Now, if I zoom out for a moment, we had all of these areas here. It's a bit hard to see on the... But you can see even these ones there were filled with those wicks, and some of these to the upside were filled with full body candles. Again, a few more there. Now, what I want you to notice is, if we zoom in, this candle pretty much covered all of these fair value gaps. These ones are covered immediately. That one there was covered by that wick. But what we've got here, if I show you from that range there, that's still unfilled orders, if you like, from those two candles. So it may not happen in next month or next week, but it could take years to play out. Again, this is the monthly. So for example, here it was, these ones weren't filled immediately until in 2021, and they were eventually filled in 2022. So this could take years to play out. And if the market does collapse, we can at least see a price retrace back into those levels at some point. So that's the monthly. That's a quick lesson on the fair value gap in terms of price retracement. Further to the weekly here, first we look at the trend, and the CCI is broken above the moving average, and so is the price. That's a bullish momentum. And again, notice here we've got some fair value gaps which haven't been filled yet. So from that range there, I'm going to stretch it across to the current period. That's the weekly minimum range. We can expect a pullback if it does start pulling back from there. On the daily, again, the trend is showing bullish momentum, the CCI and the price above the moving averages. Here we had another bearish divergence versus higher highs on the price, and I've drawn a target range in and it hasn't actually hit it. But you'll notice now I'm going to invalidate that divergence because the CCI has risen. The CCI there has risen higher than that initial point. So I'm going to invalidate that divergence and remove those trend lines. So that divergence is no longer in play. I'm going to remove that target as well. So they don't always play out. Sometimes you've got to wait for the price or the CCI to confirm. If that CCI had dropped off, then we would have continued the bearish divergence. Again, notice there we had another fair value gap, and that was filled by the wick of this candle. Had another fair value gap there that was filled quite easily, and another one more recently in there. But again, if I zoom out, let's see what we've got remaining. So that's all done. That went to about 50% was filled. So nothing that I can see there on the weekly that identifies a fair value gap. Again, the weekly, the daily, and the monthly are all independent in terms of fair value gaps and divergence. And on the daily, same sort of deal. We've got bullish momentum on the price, bullish momentum on the CCI. So taking long trades only, we had a fair value gap there that was easily filled. Another one there, filled with those that drop in those few days there. That was filled there. The 50% level was filled. So nothing there to notice. Notice here as well, when we had a bit of a pullback in April, that fair value gap highlighted in red was filled quite easily in the days following. And again up here, all those fair value gaps have been filled as well. So nothing to be concerned about there. So just be mindful of that long-term fair value gap there. Now, if we go to the micro charts, we look at even if you're trading on the daily, we look at the 1 hour chart as well. Now, what we've got in play at the moment is a bearish divergence. Lower highs on the CCI versus higher highs on the price. This actually had a breakdown of actually 3 divergence. The first one was to that level there, to that peak, and that coincided with that lower peak there. So you would have taken it back to the Fibonacci range from that high to that low, and that would have been a fill. That one there should have been up there. That would have been filled at that point there, the 23-38% level. Now, since then, the CCI has retraced higher, but notice it's starting to pull back again. So that's another bearish divergence to that peak there. So if we pull that Fibonacci to that level, and we move that to there, at the minimum, that's another 23-38% range we can expect for a pullback. In fact, that's probably already hit, because after that candle which showed the peak, you can see there it pulled back immediately into that 23-38% range. But notice the CCI is still dropping, giving us a somewhat neutral signal, even though the price is bullish. So wait for that to break higher to take long trades. And the way to trade this on the lower time frames is you wait for the CCI to break higher than the moving averages, and also the price to be higher, and you enter a trade, and you close the trade when the 3% gain is made, or a stop loss when the 5% drop has been made. And I'll show you the back test of that. Here we've got the stop loss approach, and here we've got the average down. So you average down, instead of stop loss at 5% drop, we average down when it drops by 5% and the entry parameters are met. So the stop loss approach here is breaking even pretty much with a 100,000 baseline, and the average down here is averaged down a few times, and it's generated about $5,000 worth of gains had you gone long during that period on the daily. So you trade on the 1 hour in the direction of the daily. You would not have taken long trades during that period when it broke into the downside, and you would have taken long trades during this period there as well. Just a quick tip as well, going back to the hourly chart here. Notice here we had a couple of bearish divergence. What I want you to notice here is also we had, in this very narrow range of the CCI, we had lower highs versus higher highs on the price. Let me just zoom in on that one for a moment. You can see there it's a very narrow range compared to what we've got over here on the right side. So often what I've found is when you get these very narrow divergence, whether it's bearish or bullish, you expect a lot stronger pullback. In this case, a bearish divergence and a long, stronger pullback. These ones are a lot more gradual, these longer divergence. We've got another one here as well. In between those two divergences, we've got another very narrow highs on the price versus lower highs on the CCI. Now, in this case, it dropped gradually, but then it had a powerful drop a few hours later. So I suppose the tip I'm sort of highlighting is when you see very narrow ranges, like divergence, we get a lot more volatile move to the downside in this case, or if it's a bullish divergence, a move to the upside. We had another bearish divergence back here. Notice here as well, higher lows on the CCI versus lower lows on the price, and that actually got a lot stronger to the upside. So just a tip there in terms of watching those divergences, and those probably can be traded. So for the NASDAQ on the monthly, you can see there it's been bearish on the CCI but bullish on the price with above and below the moving averages. But notice the CCI is approaching its moving averages, giving us a somewhat positive move to the upside. On the weekly, positive on both, or bullish on both the price and the CCI, with both above the moving average, so bullish momentum. And on the daily, likewise, both on the CCI and the price, bullish momentum. Again, notice the fair value gaps here on the monthly first off. We had one recently here last couple of months, and that was filled quite easily last month. We had a few back there. They were both filled with those wicks of those candles. But notice here, we've got one here sitting there unfilled at the moment. I'll drag it across to the current period. So that goes between the low of that candle or on that wick to the high of that candle on that wick for that candle's unfilled orders. This fair value gap here was filled with those 2 or 3 candles. This one touched that 25%, so that possibly could have been filled. So I'm not going to mark that at this point, but that could be the closest fair value gap unfilled at the moment, still showing marked by red on the monthly. On the weekly chart, there's one there. Let me just mark that as well. Would highlight that for future reference. And also here as well, that one is also unfilled, those areas. So we might see a bit of a pullback in the coming weeks on the weekly chart. On the daily, as I said, bullish at the moment, but you see there, let's zoom in on that one. Let me just maximize this a bit. So you can see there that dropped to about 25%, so that possibly filled those orders. These ones, however, have not been filled. Actually, no, that was filled with that wick on that candle. And that one was filled by that wick. This one dropped to about 25%, so possibly filled. But let's mark that one. Yeah, let's not mark that at the moment. So I'm going to leave that at the moment. But here we've had another bearish divergence. And that was you can see there, this is the daily. Now that's actually risen from our previous high. So I'm, again, similar to the S&P 500, I'm going to remove that divergence because that's now invalidated because that high has risen higher than that previous high on the CCI, in line with the prices, which is what we normally expect it to do. So that's the daily. Now on the intraday chart, again, we take long trades only. Here we've got a bearish divergence. You'll notice there it's pulled back. And that dropped on our Fibonacci down to the 50% range and bounced. So that was a nice little retrace. Again, always pay attention to these on the lower time frames, even if you're trading on the daily. So if you're holding this going along and you started noticing the CCI dropping lower highs, that's where you probably want to take your profits at some point. Again, there's another very narrow bearish divergence, lower highs there versus higher highs there, and that dropped a lot more strongly. And back here we had another very narrow bullish divergence, and that rose. Now again, in terms of Fibonacci retrace, we take it back to that high. And if I zoom in on that one bounced almost as high as 61%. So always pay attention to these divergences. Now, if we go to the back testing, similar to the S&P, we've got the stop loss approach and the average down approach. And I started on back here around the 27th of May. You wouldn't have taken long or short trades during that period because the CCI was in the moving average range and the price is above the moving average, so that was a neutral. So avoid taking trades, and you would have started going long again on that at that point there when that candle was above the moving average as well as the CCI. So the stop loss approach, this one did a lot better than the S&P, generated about $298 if you let it run through the whole period. Let me just get rid of that Fibonacci. And the average down approach generated about $2,265. Now notice we had a couple of drawdowns there. Always be aware of that. You may want to actually close out some trades when you start seeing the CCI drop off. So that's possibly an area you would have stopped trading on the hourly, if you notice that. And another area you would have stopped trading as well is once you started seeing the CCI dropping off and the price keep rising. So that would have been the first area around there, you probably would have stopped taking trades. But this just demonstrates what would have happened had you let it run through the whole period, and you would have stopped it. You will stop it eventually once the CCI definitely falls into that moving average range, and cut your losses. So if you're new to in trading, we're now including a video series, Pete's Investing Plus One, as part of the Pete's Investing channel. The Plus One videos are a dumbed down version of our strategies, and it gives you a better insight into our analysis and help you follow our daily videos. If you're enjoying the content, subscribe at least on a free trial to my Patreon page, where I publish weekly bullish shares across various regions of the world's markets. Thanks, and talk to you in our next video.